Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Regular listeners of this podcast should be well aware of our stance on US inflation. We believe that the disinflationary process in the world's largest economy has begun and that inflation will likely fall faster than expected by market consensus. Indeed, since June last year, after hitting a 40-year high, US consumer price inflation fell by 265 basis points. In this process of disinflation, which was recently acknowledged by the Federal Reserve Chair Jerome Powell, the data came in lower than market expectations, and this was cheered by financial markets. However, the more recent data on US consumer and producer price inflation for the month of January continued their disinflationary trend but printed higher than market expectations. In other words, January consumer and producer price inflation did not cool as much as markets expected. This seems to have created some concerns that inflation may prove to be stickier than initially expected. In this episode, we provide some perspective by looking at the US inflation through the lens of various economic agents including forecasters, consumers, businesses, financial markets, and central bankers. We'll also give you our point of view and discuss investment implications. Let's first start from the forecaster's point of view. Surveys done by both the Philadelphia Fed and the New York Fed show that forecasters' expectations of inflation have come down quite sharply across various different time frames of 1 year, 3 year, 5 year, and 10 years. Moving to consumers, inflation expectations of the next 12 months as measured by Conference Board and University of Michigan have continued to fall in recent months, while the 5-year inflation expectations of consumer have remained firmly anchored throughout the process. Through the lens of the business owners too, disinflation is firmly in place. For instance, the prices paid component of the US Institute for Supply Management ISM survey fell below 50, indicating a fall in prices in the manufacturing sector. While for services it remains above 50, indicating a continued rise in prices, the pace of the rise has slowed remarkably over the recent months. The National Federation of Independent Business (NFIB) survey of small businesses shows a similar trend, with a smaller and smaller percentage of respondents reporting higher planned and selling prices. From a financial markets point of view, disinflation is underway too. Whilst there are numerous ways of quantifying market expectations and inflation pricing, one well-known way of doing this is through inflation swaps. Here too, as is the case with consumers, both 1-year and 2-year market implied inflation rates fell sharply over the past 12 months. More longer-term inflation swaps point to a remarkably stable inflation within the central bank's target. As a result, some market-related measures of real interest rates have turned firmly positive following interest rate rises by central banks and the fall in inflation. This means, from a policymaker's perspective, interest rates are closer to a restrictive territory. Even real interest rate measures like the federal funds rate in excess of the actual CPI have risen quite aggressively over the past several months and are now approaching zero from very negative levels. Here, we continue to believe that central banks will have little incentive to keep rates elevated for very long should inflation cool rapidly. Return of the flat Phillips curve should help central bank policy to move in a relatively less restrictive direction. Our own analysis of the US Consumer Price Index showed that most of the rise in inflation is cyclical and not a structural feature. This is also seconded by the New York Fed's underlying inflation measures, where prices-only inflation is close to 4% in the US compared to the CPI, which is still above 6%. Breadth and depth of inflation across various categories is starting to ease, indicating possible disinflation in the months ahead across a wide range of categories. As such, stickiness measures of inflation have started to ease too. For instance, Dallas Fed trimmed PCE and Atlanta Fed sticky core CPI are starting to roll over from elevated levels. While we firmly believe that a strong disinflation process is underway, we assign a wider uncertainty band around the downward trajectory in inflation. One way of measuring this uncertainty is by looking at the ambiguous portion of the core PCE inflation calculated by the San Francisco Fed. This measure is elevated and needs to come down before we assign lower uncertainty for the inflation trajectory we have in mind. In short, we continue to believe that the disinflationary process that began mid-2022 is in its full force and that inflation is likely to fall faster than expected by market consensus. However, there are likely to be months where inflation could surprise to the upside in relation to expectations and cause near-term market volatility. Our wider uncertainty band around a downward trajectory in inflation does accommodate for this. As such, Long-term investors are better served by focusing on the overall trajectory of inflation rather than monthly surprises. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. To know how inflation trends might impact your portfolios, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. My name is Kishore Muktinutalapati, and I'll be back next week with another episode of Global Investment Insights.